Hello again. Apple has been a company that I have been buying and selling and buying and selling. I have bought it multiple times, made some money out of it, never really lost money on Apple. But as it's doing better and better in terms of their financials, and frankly, I was surprised by their financials looking at them some time ago. I'm actually thinking of potentially building a larger position and hold it for a few years. But I won't just be buying stock at any price, as you know. This is not what we're doing here. I want to be examining the financials and see whether it actually makes sense to buy now or I should be waiting for a better opportunity in the future. And we're going to be doing that by examining the company's financials as well as creating a discounted cash flow model with the help of our exclusive tool here in Investors Heaven and actually see what kind of price it makes sense to pay for the company. Now, if you are new here, welcome aboard and please leave a like because that really helps the channel grow and bring the content to more people and actually enables me to make even more videos. And you may want to consider subscribing because I'm gonna be making lots of new content pretty much every day. So let's talk about Apple here. A very cool company that has been growing insanely well, as you can see, and I'm always scared when I'm seeing this kind of growth, but they used to be about 180 over here, and now they're down a little bit, about 15% here, maybe a little bit less than 15%, but last year still gaining about 27%. Now, what about their outstanding shares? Are they actually diluting investors or buying back shares? Now, they are buying back shares, and that makes a lot of sense. And look at that buyback. That's absolutely insane. Wow. They used to have 26 billion in shares, and now they're down to 16 billion. That's insane. They do think that their stock price is low, and they also want to reward investors, and so they're buying back shares and adding them to their treasury. Very interesting, this thing. I mean, they have decreased their outstanding shares by about 50% here, a little bit less, 40 or something. This is absolutely insane. This is amazing for investors. I'm pretty sure they will keep doing that. And that's an extra. And this can actually bring down the valuation and actually allow you to pay even more just because it looks like the outstanding shares are going to be getting more and more decreased. And if you're buying some shares today, they may be worth intrinsically more just by the company buying back their own shares. So that's a very important thing here to bear in mind. The dividend yield are at 0.57% over here. I just quickly want to examine the payout ratio just to make sure the company has enough money. And you can see it's sitting at 15%. So you're just enjoying a little bit of dividend, just a little bit, without the company having to use a lot of its cash reserves here for paying that out. So no troubles there. Let's take a look at the income statement now. And you will see that the company has been growing tremendously well in 2021. And this is what amazed me personally, because if you look at the previous years, the company was slacking a little bit. But that year was absolutely great for Apple, and it seems to be continuing. There seems to be a continuation here. So that's pretty nice to see. And the net income of the company is sitting at 100 billion, which is absolutely insane, right? From 48 billion in 2017. Great growth as well. It's a money printing business here. And a balance sheet of that has total assets of $382 billion and total liabilities of 310 billion. That's quite a few total liabilities, but we'll examine whether they can be easily repaid. And a total equity of 71 billion over here also keeps growing for the most part, although it has been going down from 2018 to in 2017 over here. But still, I mean, it's it's an increasing stage over here, and the company seems to be doing pretty well in terms of cash. I don't have much concern here, and yeah. So the next thing that I want to examine is the cash flow statement. And we will see here that the cash from operations is very positive, from 64 billion in 2017, currently in 2021 at 105 billion, very nicely increasing, cool as well. And the cash from investing, which is negative, which is a good thing, of course, because the company is actually investing in market securities for the most part and some capital expenditures. So they do buy shares in the market, and actually bought a lot here, 10 billion. That's very interesting. Okay. And the issuance of common stock, very little issuance of common stock, but look at the repurchase. It's absolutely insane. 88 billion, 92 billion, 75. They keep repurchasing, and so they will keep doing that, I'm pretty sure. So that's absolutely awesome. Really good. And that's the payment of dividends here. It's about the same, not much increase here. And the free cash flow, look at that. Wow. 51 billion, 64, 58, 58, yeah, 73, 92 billion, 102 in the last 12 months. And remember, they had total liabilities of about 300 billion. If you remember that one in the balance sheet, the total liabilities of the company, let me find it here, we're sitting at 310 billion. So they can basically use 3 years of their free cash flow to repay everything back if they wanted to do that. So that's there's virtually no debt for Apple. It's all managed and very, very well. No concern at all for debt. The company has a lot of money here. The multiples here are a little bit high, as you can see. We want them to be around these levels. This is better. This is cheaper. And so the enterprise value right now, because of its enterprise value, is similar to market cap. If you are interested, you can actually see what it is. This is how it's actually, this is what it means really. This is how it's derived. And it's market capitalization minus the total debt and some cash and short-term investments here. And the lower these multiples are, the better they are, the better it is for you, because you are getting more sales for the market cap of the company pretty much, and enterprise value, which is a similar thing. And the profitability, which is something that is absolutely insane here. The numbers of profitability for Apple are insane. Look at that, return on total capital is at 37%, and the return on equity is off the charts here. Yeah, the company is making tons of money, and I love to see that, of course. You know me. And if you don't, you may want to subscribe, because then you will actually get to know me. So, okay. So total debt to equity here, 170%. I mean, you can understand that this is way high. This is a lot. But again, this is very managed. This is done on purpose, and it doesn't really affect my investment decision at all, because as we have examined, the cash flow of the company is just enough to pay back the total liabilities in like 3 years. And so this kind of debt compared to equity doesn't mean much, because they could be having just some extra debt in order to use it for leverage, and this can be a very, very managed decision. And for a company that's making that much free cash flow, I have no worries at all about these numbers here at all, really. So yeah, that doesn't trouble me. So the next thing we're gonna be examining here, and that's probably the most important step, is how much we should be willing to pay, because that matters a lot. Because there is always a point where an investment becomes a bad investment and an investment gets to be a good investment, and that's the price point. So we may have an asset that it's amazing, but it's amazing at a specific value or less. If you actually pay more than that, then it becomes less amazing, and the more you pay, the less amazing it becomes. And at some point, if you overpay, it becomes a bad investment. And this is what we're actually doing with this tool. This is what we're trying to figure out. And you will see details about the revenue of the company, growth and net income and free cash flow here, and a very, very handy table that we can use for our projections. You will see that the revenue growth of the company is about 11 to 12% a year for the last 5 and 3 years consecutively. And the last year, though, was the odd one out. This was insane revenue growth. Of course, we cannot use this number. This is way too aggressive here. But we will go something like 10, 11 and 12, which I think is very normal here, and it may actually be conservative based on what the company seems to be doing in the last few years. But I like being conservative. So net income margin over here, we're going to be using 20, 21 and 22. Again, we're being a little bit conservative. And the free cash flow margin, I'm going to go 95, 800 and 105. Again, we're a little bit below the averages, just to be more conservative. So these are very conservative estimates here. And an annual return that I'm typically using for normal companies is about 13% is what I want to be making a year. The return on my money, about at least 13% is what I want to be making. And if we calculate that, we are getting that currently the price to pay for the company for these estimates is at $86, $99 and $113 over here. Now again, we went a little bit conservative here. I could go a little bit more normalized, a little bit more, make some a little bit more normal assumptions here. So I can go a little bit more confident and be like 12, 14 and 15. Now the net income margin, I think I'm gonna leave it as is. I like to keep that a little bit lower. The free cash flow margin, I'm gonna go 100 here, 105 and 110. And frankly, I think these numbers are a little bit closer to the truth. And again, they are relatively conservative. They're again not too aggressive. And if I calculate with these numbers, now I'm getting what I feel is the closer of the two calculations here. And the high ones are sitting at 134, and the medium ones at 117, the low ones at 98. And I think the high ones are the most normalized ones, the more normal ones that I would go for. So what I would want to be doing with Apple here is I want to be getting it at about 130, really, based on what I'm seeing here. And the less, the better, of course. So if I get it at 120, that's even better. But I think in order for me to enter Apple, I want to be getting it at 120 to 130. And I also bear in mind the fact that the company has amazing return on investments. It has amazing return on capital and invested capital. And so I account for that. And so for that case, I think even 130, which is my higher estimates, would pay me back for my extra risk that I incur here by be willing to pay a little bit more, just because the company is doing amazingly well with their capital. So I love that. So again, I think I'm a buyer of Apple around this level, 130, which is not very far. I mean, this is like a 15% decline from here. It could happen at any point. And as I mentioned, the company is absolutely amazing. I just want to be getting it at a better price, and that's all I'm examining here. And this is my final price, the one that I would want to use in order to start accumulating some shares. Hope you enjoyed the video. Hope it helped you a little bit with your investments, and you gained some information here that could potentially help you with your decisions. If you did enjoy this video, take a look at the video that I made earlier. I'm discussing Alibaba and their potential risk of getting delisted. Is that going to be the case? We'll see. This video discusses a lot about it, and it provides very, very helpful insight, I feel. Thanks for watching again, guys, and I'll see you in the very next one. Bye-bye.